Well, hi everyone. Shaun Humphries here. Welcome to the Wise Wealth Podcast. Well, Josh, welcome. You've got I think, a busy agenda planned for us tonight. So, what are the topic areas?
Yeah, it is quite a busy one. So yeah, we're gonna touch on dementia and whether that's part of your retirement plan. It's a little bit boring, but uh,
Dementia. That's also depressing. That's actually a topic for tonight.
hey, I wasn't the one to put it in there. But then we're gonna move to the under 40s crowd theme, which is gonna be centered around the first home savings accounts. Then we're gonna
Yeah. So
move
that's
to
that's a great topic area.
yeah,
So, if you have kids trying to save for a house and looking for a vehicle to do that, it's a great vehicle. So, Josh is going to go through the ins and outs of that. So, keep going, Josh. Sorry.
yeah, perfect. The world of markets. So you were gonna touch on some market themes that are currently happening, and then finish us off with some bond information and some history around bulls and bears.
Perfect. Well, it should be a good agenda. By the way, if this particular podcast prompts any questions for any of you, don't hesitate to zip us an email, Humphries Wealth Group at asante.com, and give us the questions. We'll try to deal with those questions in our next podcast. So, you want to start with the dementia risk discussion?
Would start it off with the most exciting one.
It is super exciting. So, when it comes to our wills or powers of attorney, healthcare directives, it's not a topic that we get overly excited about. Came across an article that was written by chief actuary of Morneau Chappelle, and he was talking about the importance of really thinking through dementia risks in the context of your planning. And he made some really important points, I thought, when he wrote the article. So first of all, we always think we have time to deal with these issues. And one of the things that he reflected on, and I've seen this in my own practice, is that the longer you defer these important decisions, whether it's these documents or making important financial decisions, the more difficult it is to make those decisions. So my experience has been, and certainly the author wrote, that as people get older, they get more and more entrenched in their positions on things. And sometimes that's to their detriment. So you want to make sure that as you're crafting your estate plan and your plan to deal with issues as they come up from a healthcare standpoint, you do it well in advance, into your 60s, into your 70s, and probably not much later than that. You want to contemplate, what are the real risks? How do I make sure that I cover myself off if issues come up? So I'm going to give you three main pointers or ideas that you may want to consider. First of all, the best way of dealing with dementia risk is try to make sure that it's not a risk at all for you. So how do you do that? Well, it's things you've probably heard from your doctor. It's making sure you're pursuing a healthy lifestyle, whether it's controlling vascular risk factors like high blood pressure, high cholesterol, being socially active in your social groups, just making sure that you are attending to the basic health stuff, your social, your activity level, your diet, your nutrition. That should actually be part of your overall retirement income plan, and it helps to reduce the risks around dementia. Now, I'm going to give you a few stats on this. So, nearly 25% of Canadians aged 85 or over suffer from dementia. Moreover, comparable US statistics show that the incidence of dementia, probably of contracting dementia in any given year, more than doubles. So, as you get older, it doubles between the ages of 85 and 95. And so we've got a chart that I'm showing you right in the screen right now, and it just shows you just how that incidence increases quite dramatically in your 80s and then your 85 plus age group. Now, we know about the health aspects, and there's also just financial planning aspects. So there's a couple things. Question that you need to ask yourself: have you updated your power of attorney? And if you have, great. Did your power of attorney know where the power of attorney is? That's the second most important part. If it's been a while since you've looked at your power of attorney, more than 5 years, you may want to dust it off, make sure it's still relevant, make sure that your power of attorney is still the appropriate person. And obviously, usually you have a crisscross. If you have a partner, they're usually your power of attorney. Then you have someone who could step in the event that your partner's not around anymore or for whatever reason can't act. Now, there's been a recent document that's been introduced into the financial services industry this last year or so called the Trusted Contact Person form. And it's probably one of those rare moments where a compliance document actually is quite useful. And the TCP form, or Trusted Contact Person form, is a document that allows the advisor or financial institution to reach out to that TCP or trusted contact person if they have concerns. And the concerns could be in a number of different areas. It could be health, cognition, can't track you down. There's a whole number of issues. Now, the TCP is usually different than your power of attorney. It's someone that we can contact, but we're not allowed to release any financial information. So it's almost like a release valve. We're trying to track you down. We have a concern. We want to alert the family, and the TCP is just a great option if we feel we need to do that. That's an easy discussion to have right before an event happens. So obviously not a fun discussion. I'm meeting with a client. I'm concerned about cognitive decline. That's not really a conversation I would really welcome with a client. I'm not sure how it would be taken, and I'm not a healthcare professional. But if I have a generalized concern and I can reach out to the TCP and the client has given me advance, approval that I can do that, then allows everyone to be involved at an appropriate time if there are concerns. And if there's no concerns, great. We, maybe alerted the family to something that wasn't a real issue. I'll give you an example. Bob comes in. He seems to be a little bit not following the bouncing ball like he usually does. We finish the meeting. I'm a little bit concerned. I call Bob's TCP. Sheila says, you know what? Bob was on new meds that week. We changed the medications. He's now great. No concern, Shaun. Right? So it's not always a negative thing. It could be such a transition issue healthcare wise for that family member or client. So that's really the part of the financial planning we don't like to talk about too much. It's not like Josh said, not a fun topic, but it really is an important part of your overall financial planning and retirement planning. So again, if you haven't looked at your power of attorney in a while, dust it off, make sure it's still relevant. And if you don't have one, make sure you get one in place, because it is not fun for loved ones if you go into a period of cognitive decline, you have a stroke, dementia, and all of a sudden the family has to really look after and be attentive to your financial needs, and they don't have the necessary powers to do that. Then there has to be a court process, comitieship. It's expensive, it's time consuming. You want to make sure you dodge that particular issue. So that's that planning tip for retirement, Josh, making sure that your dementia plan is married to your retirement plan.
That was riveting.
You're lying.
Yeah.
You're
What's
lying.
that?
It wasn't riveting, but it's important. It's important.
Yeah. Yeah, moving on. I think
you put together some ideas around the first time home savings account idea.
Yeah. So this is a relatively new savings account. I think it came out in the last couple of years, and it's quite similar to the TFSA, which was our last episode was centered around. It's funny, like 2 classes ago, my buddy who had seen our TFSA video mentioned we should do one on first home savings accounts, but here we are. So a little overview. So a first home savings account is obviously, as the name says, is set up to provide people a way of saving for their first home in a tax sheltered account, right? So it's really quite similar to the TFSA in that the money is not taxed while it's growing. There's no capital gains, and if you use the money for a house when you take it out of the account, it won't be taxed on withdrawals either. So a little overview. It's a new registered account. It's a hybrid between RSPs and TFSAs, and we'll get into what that actually means a little bit. The tax deductions, the contributions are tax deductible, which kind of relates to RSPs. And the income earned is not subject to taxation. And finally, the withdrawal has to be used for your first home if you want it not to be taxable. Moving on, the contribution limit. So again, similar to the TFSA, the amount you can put in every year is capped. So for the first home savings account, it's capped at $8,000 a year with a lifetime limit of $40,000. So that's not the amount that can be in the account. That's the amount you can put in. That can grow to whatever that amount grows to. The contribution,
and of course, if you're dealing with Humphries Wealth Group, it'll probably
Yeah.
grow to an amazing amount, right?
No, exactly. The contribution carry forward available, it's $8,000 like cumulative as well. It can be deducted in the current year, or the deduction can be carried forward indefinitely. And then a big one is, and we'll talk about why this is a big one. It can be transferred into on an RSP with no, actually without deducting any like space in your RSP.
Okay,
Next,
so if you got money in
yeah,
that first time home buyer savings plan, and let's say you haven't used the full amount, there's still money residing in that account.
yeah.
You can do a transfer to your RSP account, and let's say your income's at a level where it makes sense to use that deduction. And that money that's transferred in doesn't impact your regular RSP contribution or
No,
deduction.
no. Yeah, it's actually it's really cool setup. So withdrawals and timelines. So obviously there's no tax on withdrawals for a qualified home. Now there are taxes on withdrawals if you withdraw it if it's not for a home. So that's the one big caveat. I mean, it's in the name, so it makes sense. Yeah, other withdrawals are taxable, and there's an option to transfer the RSP or RIF tax free. Again, similar to pretty much every registered account, when you turn 71, you kind of have to make those calls. And that's kind of it with the withdrawals and timelines. And next, so advantages of using a first home savings account. So again, we kind of cover these. The contributions are tax deductible. Tax deductions are not do not need to be claimed in the year a contribution was made, but can be carried forward indefinitely and deducted in a later year. Withdrawals for qualifying home purchases are tax-free. It can be used in combination with a TFSA or RSP home buyers plan towards the same qualifying home purchase. And if a qualifying home purchase isn't made within the 15-year period that you have the account, it can be transferred into the RSP or RIF tax-free without, this is the big one, without reducing available RSP contribution room. So those are
So let me just make a comment there. So what's interesting about this plan is that it almost gives you the best of both worlds, at least as it relates to the specific dollar amounts. This is for a home purchase. But what's interesting about it, often when we talk about tax-free savings accounts, one of the things that people ask is, well, is there any deduction, any tax credits for the money I put into the TFSA? And there isn't. But you say to people, well, the real power is it's giving us tax-free compounding, and when the money comes out, it's tax-free. So what you're saying about these plans is that you actually get both advantages if the money's going to get used for the house. You get the money put in, it creates a tax deduction, and then the money grows basically potentially tax-free. If it comes back out and it's used for a home, there's no tax consequences at all.
yeah, that's exactly right.
Okay. So it's a very powerful complement to tax-free savings accounts. It really is
Yeah,
harnessing both things, tax deductions and tax effective withdrawals when you purchase that house. Okay.
yeah, that's a great point. Um, so I thought we can kind of go through maybe one or two scenarios here, and that people viewing this might be in these same situations. So we'll throw the slides up so you can kind of follow along. But scenario one, someone age 24, they're just coming into a point where they want to think about buying a house, so they're going to have contribution room of $8,000 per year, and that's going to max out at $40,000. So after 6 years, the person can withdraw the funds, all the growth and the contributions are tax free, and he can put that towards their home or his home or whose ever home they're buying. And that's pretty unreal. Now, situation two, a little bit different. Let's say there's a grandparent or a parent who wants to help out their kid. The kid can open up a first home savings account. The parent can contribute the $8,000 per year for however long it does to max it out, and it's not going to affect either there's TFSAs or RSPs, and it's going to grow. The contribution and growth are going to be tax free, and whenever the person wants to buy the home, they can withdraw. So this is just a couple scenarios, and really it is simple. So the scenarios don't have to be that complicated. It's simple, and so it's pretty much. I think we covered everything there. Is there anything you want to add on top of that?
No, I think it's a good overview. Again, if you want additional information on these accounts, don't hesitate to reach out to our office, and we can provide you with a brochure that talks about it in more detail and kind of guide you through your questions. Thanks, Josh. Good overview.
Yeah, awesome.
What's next on the agenda?
Next, we're gonna move into, I think you had some stuff on, let me pull it up here. You had some stuff on the markets and a little bit of a overview on that stuff.
Right. Let me just kind of cover that off for everyone. So, um, when we're doing these market updates, it's always dependent on what's happened most recently. And markets, of course, change. They're very dynamic. A lot of things can happen in the short term. But probably one of the biggest moves in the market this last week was finally the bond market moved. So we've been talking for a while that we thought at some point interest rates would plateau, that central banks, specifically the Bank of Canada and the Federal Reserve Board, would feel that rates probably don't need to be raised much more to kind of curb the inflationary effects that were taking place. So I think we're probably pretty close to that point. So central bankers have reserved the right to increase rates if they feel they have to, but clearly the market feels that central banks are likely going to be taking a more dovish position, unlikely to raise rates anymore, and we will likely see some rate cuts in 2024. So because that was sort of the consensus by the market rallied quite aggressively. We saw yields on bonds go down. We saw bond prices rally. And this is critical for a lot of investors who just moved into the bond market trying to seize this opportunity, or people who had been in the bond market, which was a tough place to be in 2022, begin to see some price appreciation. So on average, we saw probably about a 4% move in the bond market. So we hope and expect that that move will continue. So just a few recap comments from the market. Weaker U.S. manufacturing data and a less aggressive refinancing schedule by the U.S. Treasury boosted bonds, leading to a midweek revival in the equity market and a reversal in the U.S. dollar. Labor data, which is really a key lagging economic indicator, finally softened in October in both Canada and the U.S. And this is really important because it's one of those ironies, right? When you see, economic data that's not as positive, obviously shines a light on central bank policy, maybe working to slow down the inflationary impacts. And so it seems to be that the data is emerging to confirm that. Canada's GDP remained nearly unchanged in August, falling below consensus expectations. The slowdown in economic growth is partly attributed to the Bank of Canada's tightening cycle, but special factors like forest fires and drought conditions also contributed. Now, despite the economic slowdown, core inflation still remains pretty stable, and the labor markets remain tight, leaving the Bank of Canada in a wait-and-see mode. But again, like I said, I think the central banks feel they're pretty much there in terms of where interest rates need to be. Now, the Federal Reserve decided to maintain interest rates at a range of 5.25 to 5.5, citing strong economic activity and tightening financial conditions. Their balanced approach reflects a need for more data on economic growth, labor market trends, and the impact of rising yields before making further policy changes. So that's a little bit of a backdrop, but the data seems to be, emerging behind central bank policy that the economy is definitely slowing down, and the bond market's beginning to rally with an expectation that would continue. Now, the chart that you see in front of you is a chart that shows you the bond move of Treasury notes, 10-year U.S. Treasuries. This is just in the last little while, few months. You see a move that's been pretty significant from 105 to 108, and the most recent moves over the last week or so have been pretty significant as well. So that's kind of the most recent kind of market commentary. Josh, any questions or feedback?
No questions or feedback.
I think that one of the things that I like to do when we talk about the market is step back a little bit. And this is not necessarily, something that fixes the short-term market anomalies, but it's important that we remind ourselves about how equities perform over time. And so, again, we saw a bit of a rally in equities as well as bonds. And on the equity markets, what you'll see is a slide we call it the bulls and the bears slide. And on average, the bull markets, which is in the blue, going right back to 1950 and all the way through to the more recent times, you can see that in the blue that bull markets are much longer in duration, provide a lot more growth than you see typically in bear market cycles. And so what's very difficult about investing through, particularly this last year, as you saw the bond market sell off and the stock market sell off, is that we have to remind ourselves the market's up roughly 75% of the time, down 25% of the time. And yet it's that 25% of the time that can wreck our perception of markets. And yet it's during these times of market volatility that we make money. We make money by pushing through the volatility and allowing our asset managers to invest in high quality securities to take advantage of the rebound that we likely will see. So it's just a good reminder, on average, markets are up and they're down less frequently. And our hope is that this theme of bond markets to continue to appreciate in value. And markets typically look ahead. It's one of the weird things about investing is that the markets take the current economic data and then look out the next 1, 2, 3 years, and they begin to reposition assets based on where they think the market's going to be in the future, not where the market is today necessarily. So that's a bit of an overview. Any comments, Josh?
No, I think that was pretty well done. I know you want, so bulls and bears, do you want to touch on where do those terms come from?
Well, that's a great question. I have to do some history research as to where the terms actually came from, but it's this tug of war, right? It's a metaphor for this fight between the bulls and the bears, where markets are always in this tension back and forth, and that tension is created by all kinds of things. It could be geopolitical risks around the world. It could be current market valuations in the market. It could be economic data that takes place. It could be geopolitical decisions coupled with trade laws and tax policy. And so there's that tug of war between the bull, which is a good market, and the bear, which is a bad market. And where the metaphor came from, initially, I don't know. In fact, that'll be a question we're going to address in our next podcast. Let's remember that.
I'll write it down. Perfect. Was there anything else you wanted to touch on?
I think those are the main areas. Again, we see these podcasts as an opportunity to come in and give you a bit of a potpourri of ideas that we hope will be helpful for you. And like I said, for everyone listening, make sure you reach out to us if you have additional questions that you'd like us to add to future podcasts. So Josh, thanks so much for participating, for your research on the home buyers plans. And we look forward to seeing everyone at our next podcast. Take care.